It's called looting, and it's never a pretty picture. It's a crime of opportunity, but it doesn't only occur on the streets during disasters. Today's question is it possible that the pension that you're depending upon for retirement is in the process of being looted right now? It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional style investing to your portfolio. Although defined benefit pension plans are largely a thing of the past, it's estimated there are still over 50 million pension holders in the United States alone. There are millions more throughout the UK, Japan, Italy, Germany, and other countries, and they all have one thing in common. They're facing a major challenge to the solvency of their pensions. Pension plan freezes like the one announced last October by General Electric have risen dramatically in recent years, along with pension payout offers. Pension freezes are how many companies are addressing the multi-billion-dollar pension deficits that they are facing, and payouts are a way to move pension liabilities off their balance sheet to your balance sheet. Meanwhile, shrinking tax rolls and other issues are threatening the pensions of teachers, policemen, firefighters, and other public sector workers across the country. Chief among those other issues, according to today's guests, is the mismanagement of pensions and investments and the subsequent looting of pension funds by certain forces on Wall Street. So what, if anything, can be done to stop the looting and to stop all these threats facing millions of pensions today? Are some of these same issues a threat to your retirement savings, even if you don't have a traditional pension? We'll tackle those questions and many others on today's show with the help of Robert Kiyosaki and Ted Siedle, authors of the new book, Who Stole My Pension? How You Can Stop the Looting. We'll also talk to author and podcast host Michael Stewart, founder of Crystal Lake Tax and Financial, a retirement income store located right outside of Chicago, Illinois. Plus, we want to hear from you, our loyal viewers. At any point during the show, you're invited to submit your questions and comments on today's topic, or any financial planning issue for that matter, via phone or email. Then we'll respond to your input later in the show. But before we bring in our guest, let's briefly review the rise and fall of pension plans in America and why the remaining pensions are facing so many challenges. As everyone knows, it was after the Great Depression that the idea of a social safety net, if you will, became popular. That's when Social Security was born, but it's also when pensions became common. In their heyday, pensions were an essential part of company culture. Big companies like GE, for instance, famously offered generous pensions that lured top talent and were the cornerstone of worker retention. And that was back when that was a key part of every company's business model. Pensions remained popular until the 1980s when interest rates started to decline, a trend that forced employers to start making larger deposits into their pension to fund these future liabilities. That, combined with the increasing popularity of mutual funds, gave employers a chance to pass that liability on to their workers. How? Through self-funding retirement, through plans such as 401ks. And of course, they jumped at that opportunity. Now, while pensions and 401ks both provide a means for saving for retirement, the way they accrue money differs when it comes to who owns the risk and who's responsible for managing the investments. As most people know, with a pension, the employer pays into a pool of money, and sometimes the employee may add a little bit as well. The company invests that money in hopes that it grows enough to pay a defined monthly benefit when the employee retires. State and municipal pension funds are typically structured the same way, with pension holders being guaranteed a certain benefit amount upon their retirement. If the invested money falls short of the defined benefit, well, then the employer is liable for the shortfall and must make it up in some way, shape, or form. The more frequently a shortfall occurs, the more these pension liabilities can cut into the employer's budget or their bottom line. That's why in recent years, more and more companies like GE, Ford, IBM, and Boeing have been freezing pension plans and offering lump sum payouts. Ultimately, the reason most employers have shifted their retirement programs away from pensions and into plans like 401ks is that doing so shifts the risk and liability away from them and onto the worker. However, if you're one of the 50 million Americans who still has a pension plan, then there are other risks that you should be aware of, including the outright looting of your plan by certain forces on Wall Street. Let's talk more about that with our guests, Ted Siedle and Robert Kiyosaki. They're co-authors of the new book, Who Stole My Pension? How You Can Stop the Looting. Robert Kiyosaki is known for his Rich Dad, Poor Dad book. He's also an entrepreneur and investor, while Ted Siedle is a whistleblower attorney and investment banking and securities industry professional. He actually won the largest whistleblower award in SEC history. Guys, first question, how did you two team up? This is like the odd couple here. Explain this to me.
Well, it's because there's two kinds of pensions. Ted is an expert on defined benefit pensions, which are for police officers, firefighters, school teachers, and labor unions. And I'm pretty good on defined contribution, which is known as a 401k, IRA, SEPs, and those things. But they're both in trouble today.
So, Ted, I assume it was probably your idea was probably the first one about writing this particular book about looting in pensions, or am I wrong?
Well, Robert invited me to speak to a group leaving from Fort Lauderdale on a cruise with him, and they wanted to talk about pensions. So I talked about pensions, and it went very well. I kind of roamed through the audience with a microphone and answered questions, and Robert said at the end, let's do a book together. And so
I was wrong. It was his idea. Look at that.
It was really, he had a keen interest in pensions and invited me down. So I was eager to do a book because pensions are often, misunderstood, and there's a lot of needless complexity there. So I wanted to make it very simple so people could understand. Basically there are three components to the health of a pension. One is how much money goes into the pension pot. Another one is what happens to the money as it sits for 30 years cooking in the pot. And the third is what is the money that goes out in the form of benefits so you have contributions in, benefits paid out. And if any of those three things are amiss, the pension is in trouble.
And we're going to break down all three of those in just a minute. But let me take a wild guess here. Robert, I assume the name of the book was primarily your idea, right or wrong?
Well, that's right, because pensions are going to be the biggest. It's going to be 10 times bigger than this coronavirus thing, because the pensions have been stolen.
Yeah, the nature of my question was just like that seemed like Robert Kiyosaki classic language to me when I first saw the title. We need to take a quick commercial break, gentlemen. We'll be back in a minute. We'll break this down further. Stay with us. We'll be back in a moment right here on The Income Generation.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
This trend of shifting to 401ks really took hold in the 1980s. And at that time, most workers not only didn't mind the shift, they actually welcomed it. Why? Because at that time, the stock market was in an incredible, historically high period of growth. From 1982 to 1999, America enjoyed the most lucrative long-term secular bull market in its history. This made the fact that 401ks were largely tied to mutual funds. It made this one of their most attractive features, as workers in their prime earning years saw their accounts grow exponentially. Of course, that all changed in the year 2000 when the stock market dropped by almost 50% and ushered in a new long-term secular bear market. I believe that long-term secular bear market cycle has been dragging on ever since, marked by another sustained correction of over 50% from 2007 to 2009, and by unprecedented levels of global market uncertainty in the years since the financial crisis. And as I explain frequently right here on the show, much of that uncertainty is the result of the reckless use of artificial stimulus by the Federal Reserve, as well as all other central banks around the world. I believe the result is a stock market that's become increasingly detached from economic fundamentals, and therefore is long overdue for a third major correction, one that is highly susceptible to bouts of extreme volatility. We saw this throughout 2018 as Wall Street worried endlessly over the trade war, and again in recent weeks as coronavirus fears triggered even more volatility. At the same time, we've also entered a period of historically low interest rates, which many believe may just be the new normal. All of this has dramatically increased the challenges of saving for retirement, regardless of whether you have a traditional pension or a 401k. Whether the investment risk is held by your employer or by you, that risk has been increasing ever since the turn of the century. And that's why so many companies have sought to reduce their own liability in recent years by freezing pensions and giving lump sum payouts as an alternative. Coming up after the break, we'll continue our conversation with co-authors Ted Siedle and Robert Kiyosaki on their new book, Who Stole My Pension? Welcome back. Let's bring back co-authors Ted Siedle and Robert Kiyosaki, who wrote the book, Who Stole My Pension? How You Can Stop the Looting. Thanks for sticking around, gentlemen.
Thank you.
So, okay, there's three factors. One is how much money comes in. And we just had something crazy happen this week. The interest rates plummeted. We got to a point earlier in the week, as you know, where the 30-year government bond, the yield on it went under 1% per year for the first time ever. That means that you're locking up your money for 30 years to make less than 1% per year. Gentlemen, how much is that going to affect that first lever adversely in terms of the money that needs to flow in these plans to make them work?
Well, it's going to have a profound impact, but what the pensions have been doing over the last 15 years is, as the stock market had gone up and down since 2008, is they've been loading up on high-risk, high-cost investments like hedge funds and other alternative investments, seeking to get caught up. Your average American pension fund is 70% funded. And so they're trying to fill that 30% gap by investing in these high-risk investments.
So now when the stock market did what it did over the last few weeks, Robert, that means that obviously they have to put more money in to fund it because their account balances are lower, but also the interest rates make it even harder, doesn't it? Doesn't the interest rates, don't they give the companies more temptation to take even more risk now?
Well, that is the problem. I covered in Who Stole My Pension. It really is the repo market. It's who the banks are borrowing from. And that's the biggest problem. Well, and the average guy can't see that. So they see the stock market, they don't see the corporate credit market, and they don't see the repo market. So the reason Ted and I partners up on this is he's the expert. You know, like I was, this chart over here, I was a pilot for the U.S. Marine Corps. And most of my friends went to become pilots for United Airlines and U.S. Airways and those guys, and their pensions were stolen. Right, Ted?
That's right. Yeah. They were taken over by the federal government and slashed by over 50%.
I remember that. That's terrible. And we could have another wave of those coming up, too, with what's happening with markets and interest rates. We need to take, unfortunately, another one of those pesky commercial breaks, gentlemen. We'll be back in a minute. And you stay with us, too. We'll be back here with a lot more from Ted and Robert right here on The Income Generation. Let's take a moment to talk about lump sum payouts when it comes to your pension. If your company were to offer you a lump sum pension payout, should you accept it? We've addressed that question before on the show, but it's worth revisiting this considering today's topic. And the answer depends upon a variety of factors. Usually the lump sum payout is a payout that calculates the present value of future pension payments at a prescribed interest rate. Just like if you won the lottery and you took a lump sum instead of an income option. It gets broken down kind of like a mortgage. The lump sum is the value of the mortgage. The pension payments are the mortgage payments. The term of the loan is the life expectancy of the retiree, and the interest rate is the rate approved by the IRS. For instance, a defined $5,000 per month pension, depending upon the age of the retiree, might have a lump sum value, hypothetically, of let's say $990,000. So, in this case, your choice is, would you rather have $5,000 a month for life guaranteed or $990,000 right now to invest as you see fit? Obviously, your age is important here for several reasons, including determining the size of your lump sum. However, this gets complicated because tax brackets vary based upon a whole bunch of factors, including retirement income versus working income and filing status. Obviously, that means your marital status is another important consideration, like your health and individual retirement goals. So, for example, if your goals include leaving a legacy, you should know that monthly pension payouts almost always terminate on the death of the surviving pensioner. That means the lump sum payout might be preferable if leaving an inheritance is one of your goals. Also important, of course, are other sources of retirement income: Social Security, a spouse's pension or 401k, insurance, if you're working part-time, all kinds of different factors. As well as whether to include inflation, how bad inflation is going to be down the road. What's your risk tolerance level for investments? What is your current tax bracket? Whether you think your tax bracket will go up or down when you retire and start taking required minimum distributions. The right decision regarding a lump sum payout depends on many factors and is best made with the help and guidance of the right financial professional. Now let's bring back our guests, co-authors Ted Siedle and Robert Kiyosaki, who wrote a new book together entitled Who Stole My Pension? How Can You Stop the Looting? Gentlemen, we get to run for a little while now, no more quick commercial breaks. So let's delve deeper into it. So I get it. First problem is that with interest rates being low and the stock market bouncing around like a yo-yo, companies have to put more money in. That's tougher on them and their profit margins already being squeezed. But now let's talk about when the money's there, the fees. You and I talked about that a lot in our last interview going back just a few months. Tell us about some of those hidden fees. I think you said they could be as high as 6 to 9% in some situations. Tell our viewers about that.
Yeah, that's absolutely right. Over the last 10 years or so, the fees that pensions pay have quadrupled and even gone even higher. And they're more opaque than ever. So I'm doing an investigation right now where a city pension fund in Rhode Island is paying 9% fees on a hedge fund-to-fund investment.
Did they know that they were paying 9% before you brought it to their attention?
No, it's very opaque, and of course the investment was recommended to them and by a financial advisor. So fees are escalating at pension funds, and they eat away at the net return.
Your words last time we spoke, and I've written it down. Wall Street runs circles around pension funds, creates weapons of mass financial destruction. And that's an example of running circles. Anybody who has a fiduciary responsibility running a pension, if they were to tell that person that, hey, you're paying a 6 to 9% fee, they'd say, no way. Right. But they do it. So Robert, we talked again now about the money coming in. We talked about the money while it's there. People they're tempted to take too much risk. The fees are too high. What's the problem with longevity on the back end of it, with the amount of money that ultimately has to come out of these pension plans?
Well, it's not fair. That's what Ted is saying. That's what I'm saying. See, this other picture here, that's me as a pilot, and that's my poor dad. And he was a PhD from Stanford and all that. He wasn't a poor man until he lost his paycheck, his pension, and his job. Why Ted and I got together is we both had fathers lost their pensions. So I don't have a pension. And I think that's the reason you want to read Who Stole My Pension, is what do people do who don't want or don't need a pension? You see, that pension is a whole bill of goods, right, Ted?
Yeah.
Do you think this is part of the reason, too, why in the Secure Act, the government the Secure Act explicitly said that employers will be held harmless if they include certain things like annuities as options in some of the plans? Because the government's actually starting to realize now that there's a bigger problem than maybe even they realized?
Yeah, well, the problem is retirement income for life. And so the Secure Act allows for annuities, and annuities are tremendously complex, have a lot of hidden fees, and have a lot of fees, period. So that's a real conundrum for regulators, because they recognize that workers want a predictable retirement income, but annuities are a very risky potential choice because of the hidden fees and the complexity.
And a lot of annuities, right, are quite expensive. One thing that differentiates annuities, of course, is that it's not just investment gain, it's now mortality gain. The fact that it gives it takes some of the risk to say, look, if you're the guy who lives to be 100, well, then the guy who keeled over 1 year after retirement essentially now is going to subsidize your income, so you continue to get that income guaranteed for life. Because one of the biggest problems we have socially here, and Robert, you and I talked about this when we spoke a few months ago too, is the disparity between the haves and have-nots, the rich and the poor. And we saw that because of how close Bernie Sanders, a self-proclaimed socialist candidate, actually seemed to be coming to getting the Democratic nomination. And to me, that's just a big sign that the disparity in wealth in this country is getting to a dangerous, dangerous point. And I'm sure you agree.
I agree 100% because it's not coronavirus, it's not the stock market. I think the biggest thing that's going to hit the country and the world, and our book does cover the world, is Social Security and Medicare. Medicare is already going to go bust because of obesity, because our food company is selling us fructose and all that, and we're going to die from poisoning, food poisoning. And so what's going to happen for the middle class is they don't have Social Security and Medicare or a pension, and their savings are destroyed. So that's real. That's why I started the Rich Dad Company, and that's why Ted and I joined forces. What do we tell people today? So I think the most important thing is Ted and I don't need pensions. And the question people should listen and go, well, how can I do that? I think that's a more important question than listening to Wall Street or those yo-yos on CNBC. You know, they're good people, or Bernie Sanders, or Biden, or Trump. They can't save you today. That's the problem.
Well, it sounds like the FDA is the biggest thing to save the pensions, because if the FDA is basically approving things that shortens our life expectancy, that means the pension payouts don't have to go quite that far, right? But that's not how we want to solve the pension problem, gentlemen, correct?
Right. And what we talk about in the book is that we're at the early stages of the greatest retirement pension crisis in the history of the United States and indeed the world. We're looking at 2 billion people on this planet soon over the age of 60. And the very, very slimmest percentage of those people have enough money saved to survive decades, perhaps 30 years of retirement. I mean, your average 401k balance for a 65-year-old is like maybe $50,000.
You told me last time you were here, 1% of the people over 60 have enough resources to retire. We got 30 seconds left, real quick. If I have a traditional pension plan and I want to see if it's healthy or not, what do I do? How do I go? How can I determine it?
Well, what we talk about in the book is if you have all your eggs in one basket, watch that basket like crazy. And so you can check most pensions have websites. You can get information from the pension Department of Labor information. The one thing you can't do is nothing. That's a risk you can't afford to take.
So Ted, thank you so much. Robert, of course, thank you once again. Great having you back on the show. And you stay with us too. We'll be right back in a moment, right here on The Income Generation. I'm sure you don't need me to tell you that these are particularly scary times for the financial markets. The uncertainty and instability that Wall Street and the Fed worked so hard to mask was on full display toward the end of February and into March, as fears around the spreading coronavirus triggered a stock market sell-off of historic proportions. The Dow logged its worst week since the financial crisis, and the S&P index fell by more than 11% into correction territory. Meanwhile, government bond yields also fell to record lows as the sell-off triggered a classic flight to quality in the bond market. Then as March began, the yield on the 10-year Treasury rate fell below 1% and ultimately below 0.5%. This created another inverted yield curve and forced the Fed to deliver an emergency cut that dropped its benchmark short-term rate to a range of 1 to 1.25%. And as I'm sure you know, this type of chaos has been typical of financial markets around the world since the coronavirus first emerged. Prior to that, the U.S. stock market has been experiencing a classic blow-off top rally, which saw it hit multiple new record highs since late October 2019. With the Fed and the President clearly committed to keeping the rally going, 2020 looks like it might be another strong year for Wall Street. But with the coronavirus now a factor, there are some other possibilities I believe you should consider. One possibility is that the coronavirus remains a huge unknown and the market continues getting whipsawed with 1,000-point swings per day. The best case scenario in that situation might be that the market continues trading sideways as it has since January of 2018. The other possibility is that the coronavirus ends up being the tipping point for the next major sustained stock market correction, which history tells us is already overdue and could be worse than the last two we've experienced since the turn of the century. Of course, it's too early to tell, but it's also worth noting that the tipping point for many major corrections throughout history has been something unpredictable, something that's come out of left field, just like the coronavirus. For example, everyone associates the 2000 to 2003 drop with the bursting of the dot-com bubble, but the actual sustained correction, the tipping point, if you will, didn't really take hold until a series of unpredictable events occurred. Enron, WorldCom, those scandals, and the 9/11 attacks. The situation was similar in the last major correction starting in 2007. The subprime mortgage crisis may have started off the sell-off, but the real tipping point came when major banks started failing and we learned the extent to which they had tied themselves together with these things called credit default swaps, essentially becoming a set of dominoes. When one fails, they all can go with it. Here's the point. The coronavirus has now emerged as a totally unpredictable factor out of left field, and based on history, that increases its odds of being a potential tipping point. Now, to my favorite part of the show, let's get to some of your questions and comments. So first, we have Galenda. She writes, I'm 62 and wanting to retire now, but my 401k is only about $100,000. It's all I have. What advice can you give me to increase my retirement income? Well, Glenda, thanks for writing in. And even if you transition your $100,000 of income to this universe of income generating alternatives that I talk about all the time here on the show, bonds and bond-like instruments, I like to call them, the most income you can get from $100,000 might be about $4,000 a year without taking ridiculous risks. So obviously, a big part of your retirement is going to be Social Security. And if you collect Social Security at age 70 versus at age 62, it's 80% more. The benefit is almost double. So unfortunately, it means that you may want to work as long as you can, as close to age 70 as you can, so that you can get the maximum benefit from the Social Security Administration. And of course, it depends upon a lot of factors. You know, if you have a reason to believe that your health is very poor, then maybe that changes things a little bit. But even then, if you think your health is poor and your life expectancy is short, and if you're wrong, there's too much at stake. So you might want to try to stay on board to age 70. And at this point, it's about making your retirement income go further. So it's about playing defense. So it's about going into retirement debt-free, paying off whatever debts you can, even if you have a mortgage. Thinking, okay, how can I work to get this mortgage paid off by the time I retire? Because at the end of the day, it looks like you're mostly going to be retiring with Social Security and a little bit of extra investment income. So in your case, it's almost more about budgeting defense than it is about offense. Next, we have Arnold. Arnold says, I'm recently retired. I want to know more about income-generating investments. How can I establish a safe, dependable stream of income after I've already left the workforce? Well, Arnold, you could start by watching our show every single week right here on the Income Generation, because we talk about investing for income and the income-based alternatives. Now, I urge you to be careful, because most people that are retiring today got serious about their investments in the 80s and 90s, the best stock market in U.S. history. So as a result, our generation, our paradigm for investing is about stocks and is about mutual funds. Many simply don't have the experience in that universe of income-generating options, the universe of bonds and bond-like instruments. Because remember, I'm not talking about bond mutual funds. I'm talking about things like individual bonds, where you have a contract with an issuer that says exactly what you're going to earn for the life of the bond and how much you're going to get back when it matures, providing, of course, that the issuer doesn't have financial problems and go bankrupt. Same thing with other of those income generating alternatives. So at the end of the day, a good guideline, if you do it right, is you can probably get about a 4% income stream through consistent income, interest, and dividends. But if you're like most in our generation that don't have the experience with those income generating alternatives, then you probably don't want to try this at home alone. You probably want to solicit the help of an income specialist, someone who can actually help you navigate your way through those types of tools. Because at the end of the day, you're probably smart enough that you could take a college course about investing in government bonds, a college course on municipals, a college course on corporates, one on annuities, one on preferreds, one on BDCs, one on REITs. And after 2 semesters, you might have enough textbook knowledge to do your own investing. But you have to consider, does it really make sense for you to do this if you don't have any real world experience and this is your entire life savings? So again, all I urge you to do is not try this at home. Go find a specialist who can help you in the world of income generating alternatives. And finally, we have Bill. Bill says, I'm a hospital employee. I'm about 7 years away from retirement at age 58. All my funds are with Fidelity in a 403B. Fidelity provides advisors. I'm not sure how to connect with a private service. If they hold my money, what should I do? Well, Bill, most likely, because you're a 403B holder at a hospital, it's very likely that you have to keep your money there until you retire. Teachers have typically an ability to roll their money over to an IRA and invest in anything they want after they turn 59 and a half. Age 59 and a half is a triggering event that lets them do an in-service rollover. So the first thing you might want to do is look and say, check with HR and say, can I do an in-service rollover when I turn 59 and a half? If the answer is yes, then you're only a year and a half away, and then you could basically do the same thing that I just told Arnold. Roll it over to an IRA, find an income specialist, and now you're in good shape. If not, then you're going to be limited to the mutual funds that are in your 403B, which are Fidelity mutual funds. So if you're going to find an outside manager, you'd want to find somebody who will probably charge you a flat fee, maybe an hourly fee, not so much a percentage of assets, to try to help you on which Fidelity funds would be best suited for you or which ones you might want to stay away from at this particular stage of your life. But again, that's all they could do is kind of indirectly help you and indirectly manage your money. So thank you to all of our viewers for sending us your questions and comments. And don't forget, you can reach out to us via phone or email, and you might hear me answer your question right here on the show. Financial experts have predicted that the next major recession could happen as early as this year. What would you do if it took half of your retirement savings with it? I'm David Scranton, founder of Sound Income Strategies. And there is a safer way, investing for income. By focusing primarily on non-stock market income-generating investments, you could significantly reduce the impacts of the next major recession. Visit the Retirement Income Store at soundincomestrategies.com to connect with an income specialist who can help you get started to an income-based retirement plan. As I mentioned before, in my experience, most people already understand on some level that investing for income during and in the years leading up to retirement makes sense. If they don't yet realize it, it's only because they've never had an advisor explain the income approach to them. Once that finally happens, it's like a bulb suddenly switches on over their head and they say, as the expression goes, they see the light. When I explain the income model, I try to make it easier to see that light by using analogies, including one about a hypothetical choice around a pension. For example, let's say you retired from a company that had $1 million put aside for you as a retirement benefit. Now, let's say the company offered you 2 options for how to take it. Option A was to have your $1 million in company stock. You couldn't sell the stock right away because it would be restricted, but you could collect a 2% dividend on the stock. That's $20,000 a year. Option B would be to receive a pension, an old-fashioned defined benefit pension like those we've been discussing on today's show, which guaranteed you $60,000 a year for the rest of your life. So the question is, which option would you choose? The key to the answer lies in the fact that option A offers the possibility of massive growth, while option B offers the reliability of usable income. Yes, option A also offers some income, but 66% less income than option B. Of course, there's a possibility your stock could skyrocket over time and eventually pay off huge, but there's no guarantee of that, particularly in today's wildly uncertain markets, as we've recently discussed. While there's no possibility of that big payoff with option B, there is the peace of mind that comes with knowing that you have a substantial income stream that you can count on to meet your retirement needs and your retirement goals. Each time I share this analogy with people in their 60s and even 50s, almost without fail, they agree that option B makes the most sense for their stage of life. The analogy helps them see the light and realize that what they've known all along, and that when it comes to retirement, it really, truly is all about income. Now let's welcome our next guest and my very good friend, author and podcast host Michael Stewart, founder of Crystal Lake Tax and Financial, a retirement income store located just outside of Chicago. Michael, thanks so much for joining us today.
Thanks for having me on again, Dave.
So you just heard we spent a lot of time with Ted and Robert talking about traditional defined benefit pension plans. In your experience, what percentage of your clients actually have the traditional defined benefit type pension that pays them a monthly income every year for the rest of their life?
Yeah, typically about 20% of the existing client base. And most of them have a smaller pension for maybe 20 years ago that they were vested to get a couple $1,000s a year. Unless you were in the unions or worked for the government or were a teacher, those pensions are few and far between.
Okay, all right. So guess what then? With what's happened over the last couple of weeks in the financial markets, I'm going to take those questions, I'm going to put them aside. Let's talk about the 80% of your clients. Let's talk about the 80% that have to manage, let's say, a 401k or IRAs. They thought they were on a growth trajectory since the bottom of the market 11 years ago. That got blown apart in the last couple of weeks with this crazy coronavirus. Interest rates went to a record low. So let's break it into two categories. If I'm under the age of 50, if I'm not part of the income generation, what do I do today with what's been going on in the markets if I'm trying to self-fund my own retirement?
There's really two different things you can look at, Dave. One, if you're still 15 plus years away from retirement, then you can use this recent volatility as a way to maybe increase your savings rate and try to participate a little bit more on the equity side and the market side while things are a little bit more depressed. Doesn't mean they can't go lower, but you've got time and compounding working on your side. It's those that are within about 5 years or 10 years of retirement that really should take pause right now.
Dollar cost averaging, right? In a nutshell.
Absolutely.
Yeah. Buying more shares in the markets down, fewer shares in the markets up. And if the president gets his way and he pushes through this whole thing with waiver of the payroll tax between now and the end of the year, then that's another 7.65% that most of your clients could put in the 401k, correct?
Absolutely. Yeah. Just a way to save more in a better opportune spot.
Now, how about our income generation members? We have a minute left in this segment. Over the age of 50, 10-year government bond rate went below 1% for the first time ever. Heck, the 30-year dipped below 1%. 30-year U.S. government bond dipped below 1% interest per year. First time ever in our country. So now, if you're over the age of 50, you're part of the income generation, you want to be more conservative, what do you do?
You really have to do, and we talk about it in our practice, and you talk about it on the show all the time, is as you're approaching retirement or in retirement, what you really want to do is make sure that you're positioning for income opportunities and not.
And Michael, if that's the president, tell him I'm filming a show right now. I can't take the call, but go ahead.
Yeah, I think that's someone calling in needing income. Yeah. So what it is really just taking a matter of look at your portfolio and determining how much you need from an income standpoint in retirement. Because really, as you get closer and in retirement, it's less about the growth you're going to get going forward because you really don't have the capacity to take as much risk. It's about getting sustainable, predictable income for you.
And when you take a commercial break, Ray, we come back, I want to ask you more about that topic and how our income generation members can get more sustainable income. So stay with us if you will, Michael. And you stay with us too. We'll be right back here with more coming up on the income generation in just a moment. Welcome back, and let's bring back in Michael Stewart, our very good friend and founder of Crystal Lake Tax and Financial, a retirement income store located just outside of Chicago. Michael, thanks for sticking around.
Glad to be here.
And you take care of that caller's income need while we were taking a break there? You get that taken care of all right?
I did. You were all good.
Excellent. I'm glad to hear of it. Okay, you were talking about income. So people who are over the age of 50, part of the income generation, need to start the transition from growth to income, from their accumulation, their distribution years, from stocks to bonds and bond-like instruments, right? But now all of a sudden, neither the stocks or the bond-like instruments look all that attractive. So how are you explaining this dichotomy, this challenge that a lot of people I'm sure are having when they come into your office and have talked to you about this over the last couple of weeks?
Yeah, it's been prevalent with prospective clients, especially the last couple of weeks, but even in our practice, it's been the last few years. It's really about how do we balance the need for potential growth with the immediate need for income and retirement. And we took a look at a lot of, both bonds, bond instruments, things that are paying interest and dividends on a regular basis. There's even some insured options that we use just to kind of, hasten the volatility down a little bit. But the key thing is, when you put that financial plan together, is how much risk do you need to take? You take the amount of risk you need to achieve your retirement goals and generate the income that's going to last you, and if you're married, you and your spouse for the rest of their lives. But at the same time, you don't need to take more. I love telling clients that if they've saved enough, they can generate enough income without taking a lot of risk, that they've won the game, so stop playing the game.
Mm-hmm. So you're saying, in a nutshell, that if you had yourself set up properly before the market's gyrations over the last few weeks, then you really shouldn't have to make any changes. You should be okay. It's only if you were taking too much risk going into this that maybe you need to do some real damage control. Am I hearing you correctly?
Absolutely. So the recent market volatility and the coronavirus headlines and the slowing economy, all these things are very real. But the individuals that are really getting hurt by those, the ones kind of treating like this as a fire drill or kind of panicking a little bit, are the ones that haven't planned for it properly going forward. One of the things that I pride our practice on, and in dealing with sound income strategies and retirement income generation as well in the retirement income store, is making sure that we're proactive and that we reduce the risk at the time that we need to. We don't wait for all the uncertainty going in the market and then once again have that fire drill where now we've got to panic and make changes. We try to be proactive and address it ahead of time.
And in a nutshell, we got 30 seconds. Do you think that my predictions of us going negative with interest rates in this country is going to come true now after what's happened? And if so, what can our viewers do to protect themselves?
As far as going negative, internationally, we've already seen that for well over a year now. The U.S., at the next Fed meeting, which will probably happen by the time we air here, is we're likely going to zero. So we're not that far off from going negative if things turn a little bit worse.
Yep. Good words of wisdom. Great advice, Michael. Thanks so much for being on the show once again. I appreciate it.
Thanks,
you stay with us. We'll be right back in a moment, coming up right here on The Income Generation. I'd like to thank all of our guests for joining us today for another episode of The Income Generation. I'd also like to thank you, our new and returning viewers. While it's true that defined benefit pension plans are largely a thing of the past, it's also true that an estimated 50 million Americans still have pensions. The solvency of those pensions is being threatened by a variety of forces. The bottom line, whether you have a traditional pension, a 401k, or another type of retirement account, is that for the vast majority of Americans, the responsibility of managing and trying to protect your money is no longer up to the boss, it's up to you. It's up to you to know how and where your money's invested and what risks those allocations may carry. It's up to you to know whether accepting a pension payout offer is in your best interest and aligns with your own retirement goals. It's up to you to understand what's happening in today's financial markets and how it correlates to the cautionary lessons of stock market history. And it's up to you to understand all of your savings and investment options, which include an entire universe of strategies geared toward trying to protect your principal while generating reliable income through interest and dividends. The right advisor can help you fully understand the income model and why it makes so much sense for investors in or nearing retirement, which in my experience is a concept most people already understand on some gut level. An advisor who specializes in strategies geared toward protection and income can greatly increase your odds of success. Thanks for watching. If you're close to retirement and really want to know how to protect and maximize your money, It's absolutely essential that you stay informed and up to date. And right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.
David J. Scranton's groundbreaking new book, The Retirement Income Story, will revolutionize the way baby boomers and their advisors plan and save for retirement. The Retirement Income Story, the story behind the launch of the Retirement Income Store, is about to shatter many of the myths Wall Street bankers have promoted and protected for decades. David outlines what he believes to be a much better method for planning and saving for retirement, one that doesn't involve taking on more stock market risk. In fact, most will be able to reduce and or possibly even eliminate stock market risk while creating renewable streams of income they can count on well into their retirement years. The simple truth is that if you were born in 1968 or sooner, you can't afford to ride out another catastrophic stock market drop like the ones in 2000 and 2007. Read The Retirement Income Story and revolutionize the way you plan and save for retirement.